Selecting the right stocks is an essential part of building a successful investment portfolio. But with so many companies out there, how do you know which ones are worth your hard-earned money? That's where financial metrics come in. In this video, we'll be focusing on 9 key financial metrics that can help you evaluate a company's financial health and performance. These metrics are revenue, net income, operating margin, free cash flow, shareholders' equity, total liabilities, debt-to-equity ratio, return on equity, ROE, and return on invested capital, ROIC. We'll start by looking at a table that compares these metrics for some of the biggest names in the market: Apple, Amazon, Google, Microsoft, Tesla, and Meta. Understanding these metrics is just one part of the equation. In our next video, we'll dive into the crucial question of when to buy the stocks you've selected, so make sure to stay tuned for that. Now let's get started by breaking down each of these metrics and understanding why they're important for your investment decisions. Let's begin with revenue. Revenue, also known as sales or turnover, is the total amount of money a company earns from its business activities within a specific period. This includes income from goods sold or services provided. Why it's important. Indicator of business growth. Revenue is a direct measure of a company's ability to generate income through its core business operations. Market demand. A steady or growing revenue stream indicates a strong demand for the company's products or services. Operational efficiency. While revenue itself doesn't account for costs, consistent revenue growth paired with efficient cost management can lead to higher profitability. Investment attractiveness. Investors look at revenue trends to gauge the company's potential for future growth. A company with increasing revenue is generally seen as having a strong business model and market presence, making it an attractive investment. Let's take a look at the revenue figures for the past 3 years. Apple's revenue shows a slight decline from $394 billion in 2022 to $382 billion in 2023. But it has generally maintained a high level of revenue over the past 3 years, indicating stable market demand and strong brand loyalty. Amazon's revenue has been steadily increasing, from $470 billion in 2021 to $575 billion in 2023. This growth highlights Amazon's expanding market presence and continuous innovation in its services. Google has shown consistent revenue growth, from $258 billion in 2021 to $307 billion in 2023, reflecting its strong position in the digital advertising market and successful diversification of services. Microsoft's revenue increased from $168 billion in 2021 to $212 billion in 2023, showcasing robust growth driven by its cloud computing services and enterprise solutions. Tesla's revenue growth is significant, rising from $54 billion in 2021 to $97 billion in 2023, indicating rapid expansion and increasing adoption of electric vehicles. Meta's revenue saw a dip in 2022, but rebounded in 2023 to $135 billion, showing resilience and the ability to recover from market challenges. Understanding these revenue trends helps us evaluate the growth potential and market stability of each company. Now that we've reviewed revenue, let's move on to net income to understand how much profit each company is actually retaining after all expenses. Net income, often referred to as the bottom line, is the profit a company makes after deducting all expenses, including operating costs, taxes, interest, and depreciation from its total revenue. Why it's important. Indicator of profitability. Net income is a direct indicator of a company's profitability. It shows whether the company is making money after covering all its expenses. Management efficiency. Consistent or increasing net income over time suggests that the company's management is effectively controlling costs and growing revenue. It reflects the ability to generate profits from its operations, which is essential for long-term success. Investor confidence. Investors look at net income to gauge the potential return on their investment. Earnings per share, EPS. Net income is used to calculate the earnings per share, EPS, a critical metric for investors. EPS shows how much profit is allocated to each outstanding share of common stock, giving a clear picture of a company's profitability on a per-share basis. Dividends. Companies often use net income to pay dividends to shareholders. Let's take a look at the net income figures for the past 3 years. Apple's net income has remained relatively stable over the past 3 years, with a slight dip from $100 billion in 2022 to $97 billion in 2023, indicating strong and consistent profitability. Amazon's net income shows a significant recovery, from a loss of $3 billion in 2022 to a profit of $30 billion in 2023, highlighting its ability to bounce back from financial setbacks. Google has shown a strong rebound, increasing from $60 billion in 2022 to $74 billion in 2023, reflecting its resilience and effective cost management. Microsoft's net income has been stable, with slight fluctuations, reaching $72 billion in 2023, demonstrating steady profitability and effective management. Tesla's net income has grown consistently from $6 billion in 2021 to $15 billion in 2023, showcasing its rapid expansion and increasing market presence. Meta's net income has recovered from $23 billion in 2022 to $39 billion in 2023, matching its 2021 performance, indicating resilience and strong profitability. Analyzing these net income figures helps us understand the profitability and financial health of each company over time. With net income in hand, we can now examine the operating margin to see how efficiently the company is managing its operating expenses. Operating margin is a profitability ratio that shows what percentage of a company's revenue remains after covering the variable costs of production, such as wages and raw materials. Why it's important? Profitability measure indicates how much profit a company makes per dollar of sales after accounting for variable production costs. Higher margins reflect greater operational efficiency. Cost control demonstrates the company's ability to manage its operating expenses. Competitive advantage. Companies with higher operating margins are generally better equipped to withstand economic downturns and competitive pressures, as they have a greater financial cushion. Investment appeal. A strong operating margin can make a company more attractive to investors, as it indicates a higher capacity to convert revenue into profit. Let's take a look at the operating margin figures for the past 3 years. Microsoft and Meta lead with the highest operating margins, reaching up to 44.17% and 29% respectively. This indicates exceptional cost control and high operational efficiency. Google maintains strong and stable operating margins, around 27 to 30%, reflecting effective cost management and robust profitability. Apple shows an operating margin of 31% in 2023, consistent with previous years. This suggests effective cost management, despite a slight decline over the past year. Amazon and Tesla have lower operating margins, around 6 to 9%. This reflects ongoing investments in growth and infrastructure, which can impact short-term profitability, but may lead to higher long-term gains. Having assessed the operating margin, let's turn our attention to free cash flow to determine how much cash the company is generating after capital expenditures. Free cash flow (FCF) represents the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. Why it's important? Cash generation (FCF) measures the actual cash generated by the company's operations, excluding non-cash items like depreciation. Financial health indicator, strong and consistent FCF, indicates that a company is financially healthy and has enough liquidity to support its operations, invest in growth, and manage economic downturns without relying on external financing. Investment capability. High FCF allows a company to reinvest in its business, fund new projects, acquire other businesses, or improve its infrastructure without needing to raise additional capital. Shareholder returns. Companies with strong FCF often use it to pay dividends and buy back shares, enhancing shareholder value and making the stock more attractive to investors. Debt management. A strong FCF enables a company to manage its debt effectively, making it easier to meet interest payments and pay down principal, thus reducing financial risk. Valuation metric. Investors use FCF in valuation models like discounted cash flow, DCF analysis, to get a more accurate picture of a company's financial performance and future growth potential compared to net income alone. Let's take a look at the free cash flow figures for the past 3 years. Apple stands out with the highest free cash flow, reaching $99.58 billion in 2023. Amazon shows significant improvement in free cash flow, with figures of $32.22 billion in 2023. This indicates solid cash flow despite ongoing investments in infrastructure and technology. Google reports a robust free cash flow of $69.5 billion in 2023, indicating stable cash flow from its advertising business, maintaining consistency over the years. Microsoft has maintained a strong free cash flow of $59.48 billion in 2023, demonstrating its operational efficiency and ability to invest in areas like cloud computing and artificial intelligence. Tesla reports a lower free cash flow of $4.36 billion in 2023, which reflects its aggressive expansion and high capital expenditures. Meta shows a significant increase in free cash flow, reaching $43.85 billion in 2023. This improvement highlights its enhanced cash generation capabilities and ability to manage capital expenditures effectively. Next, let's look at shareholders' equity to gauge the value of the company's net assets that are owned by its shareholders. Shareholders' equity represents the owner's claim after all liabilities have been subtracted from the company's total assets. It's essentially the net worth of the company from an accounting perspective. Why it's important? Indicator of financial health, shareholders' equity is a key indicator of a company's financial stability and health. A growing equity base suggests the company is profitable and retaining earnings to reinvest in growth. Debt management. By comparing shareholders' equity to total liabilities, investors can assess the company's leverage and risk. Value for shareholders. Rising shareholders' equity often translates to increased value for shareholders, reflecting the company's ability to generate wealth over time. Let's take a look at the shareholders' equity figures for the past 3 years. Apple's shareholders' equity has fluctuated slightly, showing a slight decrease in 2022, but rebounding to $62 billion in 2023, indicating a stable financial foundation. Amazon's equity has significantly increased from $138 billion in 2021 to $202 billion in 2023, reflecting its strong growth and reinvestment of earnings. Google has consistently grown its equity from $252 billion in 2021 to $283 billion in 2023, showcasing its robust financial health and ability to generate wealth. Microsoft's equity has seen steady growth, from $141 billion in 2021 to $206 billion in 2023, indicating strong financial performance and effective management. Tesla's equity has more than doubled from $31 billion in 2021 to $63 billion in 2023, highlighting its rapid expansion and successful growth strategy. Meta's equity has also grown significantly, from $125 billion in 2021 to $153 billion in 2023, demonstrating its financial resilience and profitability. Examining these numbers, Google stands out with the highest shareholders' equity, reaching $283 billion in 2023, reflecting substantial retained earnings and a strong financial foundation. Microsoft follows with $206 billion, showing steady growth in equity. With shareholders' equity established, we'll now consider total liabilities to understand the company's total debt obligations. Liabilities are the company's financial obligations or debts. They include loans, accounts payable, mortgages, deferred revenues, and other forms of debt. Why it's important? Financial stability. Liabilities show how much a company owes to others. High levels of debt can be risky, especially during economic downturns, as the company must continue to make interest and principal payments, regardless of its financial performance. Debt-to-equity ratio. This ratio compares the company's total liabilities to its shareholders' equity. It provides insight into the company's financial leverage and risk. Interest expenses. High liabilities often lead to high interest expenses, which can eat into a company's profits. If a significant portion of the company's revenue goes towards paying interest, it can limit the company's ability to invest in growth opportunities and reduce overall profitability. Solvency and liquidity. Understanding a company's liabilities helps assess its solvency, long-term ability to meet financial obligations, and liquidity, short-term ability to cover its immediate debts. Credit rating. A company's level of liabilities can impact its credit rating. Higher debt levels may lead to lower credit ratings, increasing borrowing costs, and limiting access to additional funding. Bankruptcy risk. Excessive liabilities can increase the risk of bankruptcy, especially if the company faces a sudden drop in revenue. Monitoring liabilities helps investors understand the financial risks associated with a company. Let's take a look at the total liabilities figures for the past 3 years. Examining these numbers, Amazon has the highest total liabilities, reaching $326 billion in 2023, reflecting its extensive operations and significant investments in infrastructure and technology. Microsoft follows with $205 billion, highlighting its ongoing commitments and financial leverage. Apple's total liabilities have shown a slight decrease from $302 billion in 2022 to $290 billion in 2023, indicating strong financial management and debt reduction efforts. Google maintains stable liabilities, increasing slightly to $119 billion in 2023, reflecting a balanced approach to debt management. Tesla's total liabilities have grown from $31 billion in 2021 to $43 billion in 2023, aligning with its rapid growth and expansion strategies. Meta's liabilities have increased significantly, from $41 billion in 2021 to $76 billion in 2023, suggesting growing financial commitments. With total liabilities in mind, let's analyze the debt-to-equity ratio to see how much debt the company is using relative to its equity. The debt-to-equity ratio is a financial metric that compares a company's total liabilities to its shareholders' equity. It shows the proportion of debt used to finance the company's assets relative to the value represented by shareholders' equity. Why it's important. Financial leverage. This ratio indicates the extent to which a company is using debt to finance its operations. A higher ratio means more debt relative to equity, which can amplify profits but also increase risk. Risk assessment. A high debt-to-equity ratio suggests greater financial risk, particularly during economic downturns. Companies with higher debt levels might struggle to meet their obligations during tough times, potentially leading to financial distress. Investor insight. Investors use this ratio to gauge the company's financial health. Generally, a lower debt-to-equity ratio is preferred as it indicates a more conservative borrowing approach and stronger equity position. Cost of capital. Companies with high ratios might face higher interest rates and borrowing costs due to perceived risk. Conversely, a lower ratio can result in better borrowing terms and lower interest expenses. Growth potential. While debt can fuel growth, excessive reliance on it can limit a company's ability to invest in future opportunities. A balanced ratio ensures that the company can fund expansion while maintaining financial stability. Let's take a look at the debt-to-equity ratios for the past 3 years. Looking at the debt-to-equity ratios, Amazon has the highest ratio at 1.61 in 2023. This indicates a significant reliance on debt to finance its operations, which can signal aggressive growth strategies but also higher risk. Microsoft follows with a ratio of 1.00, reflecting a balanced use of debt. Apple's ratio has decreased to 4.68, suggesting a steady reduction in debt relative to equity over the years. Google maintains a low and stable ratio, around 0.42, indicating a conservative borrowing approach. Tesla's ratio has improved to 0.68, showing a reduction in debt reliance, while Meta's ratio has increased slightly to 0.50. This low ratio reflects Meta's strong financial position with minimal reliance on debt. By examining these ratios, we gain insight into each company's financial leverage and risk profiles. For instance, Amazon's higher ratio suggests it is more leveraged, potentially offering higher returns, but also greater risk. Conversely, Meta's low ratio indicates a conservative approach, prioritizing financial stability. Now that we've covered the debt-to-equity ratio, let's explore return on equity, ROE, to evaluate how effectively the company is using shareholders' equity to generate profits. Return on equity, ROE, measures a company's profitability relative to its shareholders' equity. It indicates how effectively management is using the company's assets to generate profits. Why it's important. Performance metric. ROE shows how well a company is converting equity into profit. Higher ROE values typically suggest better efficiency in generating returns from shareholders' investments. Management efficiency. A high ROA reflects effective management and a sustainable competitive advantage. Comparative analysis. ROE is useful for comparing companies within the same industry, helping to identify those that are more effective at generating returns from their equity. Investment decision. Investors often prefer companies with high ROE as it suggests strong profitability and effective use of shareholders' capital. Growth potential. Companies with high ROE can reinvest their profits at a higher rate, leading to accelerated growth. Let's take a look at the return on equity numbers for the past 3 years. Apple demonstrates an exceptionally high return on equity, or ROE, of 156.45% in 2023, significantly improving from previous years. This outstanding figure reflects Apple's remarkable profitability and effective utilization of shareholders' equity. Microsoft shows a strong and consistent ROE, with a figure of 34.95% in 2023, indicating effective management and profitability, although slightly lower than in previous years. Google reports a stable ROE of 26.15%, reflecting consistent profitability and efficient use of equity, even though it has decreased from previous years. Meta has improved its ROE to 25.49%, showing an upward trend and efficient management of equity, contrasting with a decline in previous years. Tesla has an ROE of 23.81%, reflecting solid profitability and efficient use of equity, although it is lower compared to previous years. Amazon shows a lower ROE of 14.85%, recovering from negative values in 2022. This suggests a gradual improvement in profitability, but still reflects challenges in generating returns from equity. Finally, let's conclude with return on invested capital, ROIC, to assess how well the company is generating returns on all invested capital, including both equity and debt. Return on invested capital, ROIC, measures how effectively a company generates returns on the capital invested in its business, including both equity and debt. Difference from ROA. ROIC evaluates the return on all capital invested in the business, which includes both equity and debt. This provides a broader measure of efficiency in generating profits. In contrast, RO only considers the return on shareholders' equity, which can be influenced by leverage. ROIC is therefore a more comprehensive indicator of how well a company is using its total capital to generate returns, regardless of its financing structure. Why it's important. Efficiency measure. ROIC indicates how efficiently a company utilizes its capital to generate profits. Higher ROIC values suggest better capital efficiency. Investment quality. A high ROIC shows that a company is effectively generating returns on its investments, reflecting high-quality investment opportunities. Comparative analysis. ROIC allows for comparisons across companies within the same industry to identify those that are more effective at generating returns on their invested capital. Growth potential. Companies with high ROIC can reinvest their profits more effectively and fund future growth opportunities without needing additional external capital. Let's take a look at the return on invested capital numbers for the past 3 years. Apple maintains a robust ROIC of 27.56%, indicating effective capital utilization and strong profitability. Microsoft exhibits the highest return on invested capital, or ROIC, at 17.52% in 2023, reflecting a strong capability in generating returns on invested capital. Meta shows an improving ROIC of 17.03%, up from the previous year, signaling growing efficiency in capital utilization despite past fluctuations. Google has a stable ROIC of 18.41%, reflecting consistent performance in generating returns on its capital investments. Tesla displays an improving trend with a ROIC of 14.15%, an increase from past years, indicating better profitability and capital utilization. Amazon reports a lower ROIC of 5.68%, recovering from negative values in 2022. This reflects the impact of heavy reinvestments and growth strategies, which may affect short-term returns but could lead to higher long-term gains. Now that we've examined each metric individually, let's take a look at the combined data for the last year. Apple: strengths, high net income, strong free cash flow, robust ROE, and operating margin. Concerns: relatively high debt-to-equity ratio. Overall, Apple demonstrates strong profitability and cash generation, though its debt levels are a concern. Amazon: strengths, significant shareholders' equity. Concerns: lower net income and highest debt-to-equity ratio, reflecting higher leverage and potential risk. Overall, Amazon is heavily reinvesting, which impacts current profitability but signals a focus on long-term growth. Google: strengths, high net income, substantial shareholders' equity, low debt-to-equity ratio, and strong free cash flow. Concerns: slightly lower RO compared to Apple and Microsoft. Overall, Google has a solid financial foundation with consistent profitability and low debt. Microsoft: strengths, highest net income, significant free cash flow, strong ROE, and operating margin. Concerns: moderately high debt-to-equity ratio. Overall, Microsoft combines high profitability with robust cash flow and efficient operations, although its debt levels are somewhat elevated. Tesla: strengths, low debt-to-equity ratio. Concerns: lower net income and free cash flow compared to peers. Overall, Tesla is in a growth phase with high reinvestment, indicating potential for future profitability despite current lower financial metrics. Meta: strengths, strong net income, lowest debt-to-equity ratio, and robust operating margin. Concerns: lower free cash flow compared to Google and Microsoft. Overall, Meta shows consistent profitability with a strong balance sheet, although its free cash flow is relatively lower. So who are the clear winners? Microsoft, due to its highest net income, strong free cash flow, and efficient operations. Google, due to its substantial shareholders' equity, low debt, and strong profitability metrics. Final remarks: understanding these financial metrics helps you evaluate how businesses are performing, their growth potential, how they use their capital, and how to create a watch list of stocks from the vast array available for trade. Net income shows profitability, indicating how well a company converts revenue into profit. Free cash flow reveals how much actual cash a company generates, which is crucial for dividends, reinvestment, and debt repayment. Return on equity, ROE, and return on invested capital, ROIC, measure how effectively a company generates profit from shareholders' equity and invested capital, respectively. Operating margin indicates efficiency in managing operating expenses relative to revenue. Consistent growth in net income and shareholders' equity reflects ongoing profitability and reinvestment into the business. Free cash flow trends demonstrate the company's ability to fund expansion and innovation without relying on external financing. Debt-to-equity ratio helps assess how much a company relies on debt versus equity to finance its operations. A balanced ratio indicates prudent financial management. Total liabilities provide insight into the company's debt levels, which impact its financial stability and risk profile. Creating a watch list. Evaluating large companies, the metrics we've discussed provide a comprehensive view of large, established companies. While these giants offer robust performance and stability, they may have limited growth compared to smaller, emerging companies. Finding winners among smaller companies. For smaller companies, these metrics can be instrumental in identifying potential growth opportunities. Smaller firms with high ROIC, strong free cash flow, and improving operating margins might offer greater growth potential and investment returns. By using these metrics, you can filter and compare companies based on key financial health indicators, rather than delving into complex financial statements. This approach allows you to identify potentially strong investment candidates and create a targeted watch list, focusing on companies that demonstrate robust performance, growth potential, and effective capital utilization. Remember, this video is for educational purposes only. We do not recommend buying or selling any stocks. Please conduct your own research or consult a professional before making any investment decisions. Feel free to share your thoughts in the comments below. We'd love to hear which company you think has the most compelling financial profile and why. Stay tuned for our next video, where we will learn about the crucial question of when to buy the stocks you've selected.